Welcome to the Knakal News Network. The Knakal News Network is brought to you by the Knakal Group, Cushman & Wakefield's #1 investment sales team.
Hi, I'm John Hageman, Executive Managing Director for Cushman & Wakefield. Welcome to the Knakal News Network. Today I'm here with Bob Knakal, Chairman of New York Investment Sales, and today we're going to talk about the first half 2017 investment sales market. So Bob, now that the first half is behind us, tell us what we saw in the first half of the year so far.
First half of the year, Hags, it's been pretty ugly. We saw, starting in the fourth quarter of 15, we started to see fundamentals start to degrade a little bit. And that immediately impacted the land market and the hotel market. Those are the two markets that are the most highly reactive to changes in the market. We saw stress in both of those sectors. And as fundamentals started to degrade, that exerted downward pressure on value. So volume starts to drop, and that's exactly what we've been seeing. We've seen that values have been rising, but rising at a decreasing rate, but volumes have been literally falling off the table since the fourth quarter of 2015.
So Bob, you specifically mentioned volume, and that's something we always focus on. What does that look like over the last 3 years?
Okay, well, if you go back to 14 and 15, I'll always use those as the benchmarks because those were the cyclical peaks. In 2014, 5,534 buildings were sold, an all-time record by more than 10%. 2015, 77.1 billion in sales volume. Those were clearly the peak of this cycle in terms of our volume metrics. What has played out so far in the first half of 2017 is we've seen the dollar volume of sales was approximately 16.9 billion. If we annualize that, it's about 32.9 billion that we're on pace for, which would finish the year 43% below the 57.8 billion in sales we had last year. We're actually running at about 57% below where we were at the peak of the market in 2015.
So Bob, that's dollar volume. What about the number of buildings sold?
Well, number of buildings sold is also down, not quite as dramatically as the dollar volume, but we're still seeing significant reductions from where we were in previous years. With regard to the number of buildings sold, in the first half of 17, we had a pace that would bring us to about 3,756 sales for the year. That would be about 14% below last year's 4,376 sales and 32% below 2014's all-time record. Interestingly, though, the pace of sales citywide, if you look at our statistical sample of 165,000 properties, our pace this year would put us at about 2.3%, which is the long-term average that we've seen. So as horrible as it seems, the previous years have been so good that we're really just on an average pace.
Bob, you mentioned some troubling trends that we're seeing, but if this year it's trending towards the long-term average, what do you think the reason for that is?
Right. Well, Hags, you always want to kind of dig down and dive deeper into these numbers to get a good understanding. And the troubling thing is that we always have to keep in mind that whatever happens in New York City happens in Manhattan first. And unfortunately, the Manhattan market is lagging way behind the outer boroughs. And that will foreshadow trends moving forward, and that's the troubling thing. So if we look at how Manhattan has performed, we see that it is really lagging the boroughs significantly. The Manhattan sales market's on pace for about 19.8 billion this year, which would be 50% below 2016's 39.6 billion, and a whopping 67% below the 59.9 billion of sales that occurred in 2015. If you think about what that $19.8 billion of sales represents, in 2008, there were 19.8 billion in sales in Manhattan. So if we remember, 2008 was an absolutely horrible year, and that's where we are today in terms of dollar volumes. If we look at how the outer boroughs are performing, sales volume is running at about 13.1 billion, which is only 29% below 2016's 18.2 billion. From the peak, you see a 67% reduction in Manhattan and only a 29% reduction in the outer boroughs. That's a very troubling indicator.
But what about the actual number of buildings sold in Manhattan and where it's trending towards the rest of the year?
The number of buildings sold in Manhattan is also underperforming the broader market. If we look at the number of buildings sold in Manhattan, we see that we're on pace for about 616 sales this year, which would be 43% below the cyclical peak, while in the outer boroughs, the pace is only about 31% below the cyclical peak. So again, the outer boroughs are doing relatively better.
So we've talked about dollar volume, we've talked about number of buildings sold, but what about relative value?
Value in Manhattan has increased about 2% this year, whereas in the outer boroughs, value is up about 7%. But what we see, if we look at the graphs of what these trends have been in price per square foot, we see that the trend in Manhattan is very concave. The market is clearly plateauing, and if we look at the graphs, we see that. Whereas in the outer boroughs, that curve is more convex. It's still trending upward. But again, the troubling fact is that whatever's going to happen in the city will happen in Manhattan first. So we believe that value in Manhattan is very likely to finish the year below where it started the year, and that trend will get contagious into the outer boroughs.
So Bob, taking a step back and looking at the big picture, what does this mean for the rest of the year and where the market's heading into 2018?
Well, Hags, I think we are in a correcting market. As we've discussed, we're 22 months into this. This may go on for another 12 months, 18 months. But the good news is that if we do go through this correction and there is a reduction in property value, we expect that reduction to be very, very mild. There has been no catalytic event that has made this correction in the market occur. We haven't had a stock market crash, a housing crisis, a credit crisis. Nothing has precipitated this. This is just the natural cyclicality of the market. The real estate market always has been cyclical, is cyclical, and always will be cyclical, and I think we're just going through that. So we've seen the big reductions in volume. We see values plateauing in some sectors, like the land sector. We see values coming down a little bit, but all in all, this should be a relatively soft landing, and it'll be interesting to see how the rest of the year progresses. In summary, the volume of sales in the first half of 2017 continued to slide to levels significantly below where they were at the cyclical peak. This was the case for both the dollar volume of sales and the number of properties sold. Property values in the city continue to rise, although they are increasing at a reduced pace.
Thank you for joining us today. Tune in next week for another episode of the Knakal News Network.